Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at D-Wave Quantum.
And if you find our talks useful, please consider subscribe, like, and comment underneath. It really helps out.
Yeah, and a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices, and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence.
Right.
But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10K is not guaranteed. Use these tools for education and analysis only. Manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Absolutely. All right, so let's jump right into the hook for today. Because, the market action we are seeing with D-Wave is just completely wild.
Oh, it's fascinating. We are not just talking about, abstract science here. We're looking at a monumental market event.
Yeah.
D-Wave stock literally surged over 33% in a single day.
Over 33%, just in one session. That is
in one session.
Yeah.
And the shock waves from that single move added nearly $4.9 billion in combined market value across the entire quantum computing sector.
Which is just, it's a staggering amount of wealth generated in a matter of hours,
That's definitely.
Imagine finding out the government just bought a massive direct equity stake in, your neighborhood's most eccentric, high-risk science project. And suddenly, everyone on the block just wants a piece of the action.
Yeah, everyone wants in because, and this is the crazy part, the trigger for this wasn't an earnings beat. It wasn't some shiny new product launch.
Yeah.
It was a $100 million cash injection from the U.S. government through the CIPS and Science Act.
Right. The Department of Commerce essentially signed this non-binding letter of intent to take that $100 million specifically in common stock.
And that is the crux of why the market reacted so violently. This isn't a traditional grant.
Right.
Or a standard government loan.
Which is what you usually see.
Exactly. The government is stepping in to act almost like a venture capitalist here. They are taking a direct equity stake in a bleeding-edge tech company.
All right, let's move into the wealth building context, because looking at this, quantum computing has historically been labeled as deeply speculative. It's, the stuff of science fiction.
Totally.
So why is the U.S. Department of Commerce suddenly playing the role of a Silicon Valley angel investor?
Well, to answer that, you really have to look at the geopolitical context. This move is heavily driven by the current administration's strategic policy to definitively outpace China in frontier technologies.
So it's an arms race.
It's a literal technological arms race. Because quantum computing isn't just about making, faster smartphones.
Right.
It has the potential to break current encryption standards, optimize national power grids, revolutionize material science. By putting $100 million into D-Wave Quantum, the U.S. government becomes financially incentivized to see this specific company succeed.
It creates deep policy continuity.
Exactly. It's essentially a state-sponsored tailwind for your portfolio if you're holding this.
Okay, but let's dig into the technology itself for a second, because D-Wave isn't just doing what everyone else is doing, right? They have this dual platform moat.
Right, they do.
And they are the first mover in something called quantum annealing, which is supposedly very different from what giants like IBM are doing. Can you break down how that actually works?
Yeah, absolutely. So the broader industry, competitors like IBM, they are heavily focused on what's called general-purpose gate model computing. And without getting too bogged down in the physics of it all, gate model systems try to use qubits, which are quantum bits, to run complex algorithms.
But there's a catch, right?
A big catch. Qubits are highly unstable. They need massive amounts of error correction. So most experts agree that commercially useful, fault-tolerant gate model computers are still years, maybe a full decade, away.
Okay, so that's the long-term bet for the sector. But where does D-Wave's annealing come in? Why does the government care right now?
Because quantum annealing is fundamentally different. It doesn't try to be a general-purpose computer. It is purpose-built to solve highly complex optimization problems.
How so?
Let me give you an analogy. Imagine you are trying to find the absolute lowest point in this massive, incredibly complicated maze. A classical computer would have to test every single path one by one, measuring the depth until it finds the bottom.
Which takes a massive amount of time and power.
Exactly. A quantum annealer, on the other hand, is like flooding that entire maze with water.
Right.
The water instantly flows to the lowest point all at once. It uses the physical properties of quantum mechanics to naturally settle into the optimal solution.
That's a brilliant way to visualize it. So instead of calculating the answer step by step, it just physically settles into the answer.
Precisely. And because of that, it is useful right now. You can use it today for global logistics, supply chain routing, massive scheduling networks.
Right, real-world applications.
Yeah. D-Wave is actually the most commercially deployed quantum computing firm among its peers because they have paying customers using these annealing systems today.
So when the government wrote that letter of intent, they were specifically validating this annealing approach.
Exactly. It removes the purely speculative label that has, kept a lot of institutional money on the sidelines.
Now let's look at the fundamentals. Because if the tech is so amazing, we need to see how the business is actually doing. And honestly, the fundamentals right now are pretty stark.
Stark is putting it mildly, honestly.
Yeah. I mean, looking at the Q1 2026 earnings report, you immediately see the problem. Their revenue severely contracted down to just $2.86 million.
Yeah, which is a massive drop.
Right. Down from the $15 million they reported in the same period last year.
And it gets worse in the bottom line. Their net losses widened to $18.36 million for the quarter.
Wow.
Gross margins are sitting around 33%, and their free cash flow is decisively negative.
Well, because of those massive R&D costs we just talked about, right? Building quantum computers isn't cheap.
Not at all. There are no immediate operational efficiencies that are going to just magically expand those margins tomorrow. The business is highly lumpy and deal-driven.
What does that mean in practice, though, for the investor looking at this?
It means they aren't selling, thousands of small software subscriptions every day. Their revenue path depends entirely on enterprise-level adoption of their quantum computing as a service, or QAS.
QCS.
They are trying to get massive corporations to access their quantum hardware via the cloud to solve huge problems. But landing those deals takes time.
Right. Enterprise sales cycles are notoriously slow.
Exactly. So one big contract can make a quarter look amazing.
Like that $15 million quarter last year.
Exactly. And then the absence of a deal makes the next quarter look terrible, hence the $2.86 million.
So they are relying on these massive, infrequent whales to survive while spending a fortune on R&D every single day. That sounds terrifying for an investor.
It does. But you also have to look at the forward-looking projections from bullish analysts, because the contrast is staggering.
Right. What are they projecting?
If you look past the current lumpiness, optimistic analysts are projecting D-Wave to hit $122.5 million in revenue by 2028.
That is exponential scaling.
It is. To get there, they would need a 71.8% compound annual growth rate. And it goes further. By 2029, those same projections model $180 million in revenue, with $22 million in actual earnings.
Okay, wow.
Yeah, based on those models, some analysts are assigning a fair value target of $38.54 per share.
So if you believe the thesis, the Q1 disaster is just a temporary speed bump on the way to dominance. You're paying a premium today for revenue that will supposedly explode once enterprise adoption reaches an inflection point.
Exactly. That's the bull case in a nutshell.
That brings us to the catalyst timeline. With these aggressive projections, what are the actual concrete milestones we need to look out for next?
Well, the most immediate concrete event staring us in the face is the June 1st Investor Day.
Okay.
This is going to be their most important presentation in years.
It's basically their Shark Tank pitch to the public, right? I mean, they've already secured the biggest investor possible in the U.S. government. Now they have to unroll the blueprints and show everyone else how they plan to spend that money.
Exactly. Management has to articulate exactly how this $100 million accelerates their technological roadmap. The internal goals they are chasing are monumental.
Like what?
Well, they want to build a 100,000 qubit annealing system and a 10,000 qubit gate model system.
Wait, I thought they were just focused on annealing.
That's the dual platform approach we mentioned earlier. Annealing is their current commercial product, but they're also using their R&D to develop a gate model system for the long term.
Ah, covering all their bases.
Exactly. And the expectation is that this new cash could potentially unlock a 3-year R&D head start over their competitors on both fronts. June 1st is where we get the granular details on how that timeline actually works.
So June 1st is for the tech roadmap. What about the financials? Because Q1 was a mess.
For the financials, Q2 2026 earnings will be the ultimate test. The market gave them a free pass on the terrible Q1 numbers because the government bailout completely overshadowed it.
But Q2 needs to show stabilization. We need to see that QKS revenue stop declining and start growing. If that lumpiness doesn't smooth out soon, the market's patience will run thin, regardless of the government's backing.
And there's also some intense speculative chatter happening right now, isn't there?
Oh, yeah.
Rumors are swirling that D-Wave's existing partnerships with defense contractors, specifically Davidson Technologies and Anduril Industries, might be on the verge of converting into massive, binding U.S. missile defense contracts.
Which logically tracks with the macroeconomic thesis we discussed earlier.
Right.
If the U.S. government is now a direct equity stakeholder, it is highly incentivized to funnel sensitive defense contracts to a domestic partner they essentially co-own. It ensures the technology matures securely within the domestic supply chain.
But as an analytical investor, I have to point out that these are unconfirmed rumors. Buying a stock purely on the hope of a secret missile defense contract is the definition of speculation.
It is. But it's exactly the kind of speculation that thrives when a company gets this kind of high-profile validation. The rumors alone provide a supportive floor for the stock's momentum in the near term.
Now let's pivot to the chart, because with financials that lumpy and projections that aggressive, how exactly did the technicals play out this week?
It was incredibly explosive. The stock had been hovering in a pretty tight consolidation range between $20 and $21.
Okay.
Then the QBTS Act news hit, and it violently broke out, closing at $25.74.
Wow.
It even climbed another 7.81% in after-hours trading.
Which tells us that institutional buy-side demand was heavily outstripping supply even after the retail traders logged off for the day.
Exactly. It was their best day since last May.
But if we zoom out, the chart shows the stock is still actually down about 1% year-to-date.
Yeah, that's true.
And it is trading well below its 52-week high of $46.75. To me, that implies a massive amount of overhead supply. You know, people who bought at $40 who might just be waiting to break even so they can sell.
That's a really critical observation. Technically speaking, there is room for mean reversion, but it has to fight through that past resistance.
Right.
However, the nature of the price action this week wasn't just driven by fundamental long-term buyers.
So what does market sentiment look like? What really drove it?
We have to talk about the squeeze factor.
The short squeeze.
Yes. Going into this government announcement, 14.1% of D-Wave shares were sold short.
That's a lot.
It is. And a lot of those short positions were established when the stock was near its all-time highs.
So that creates a highly combustible environment.
Totally. Because a short seller borrows shares and sells them, hoping the price goes down so they can buy them back cheaper. But when a surprise $100 million lifeline from Uncle Sam drops out of nowhere, the stock spikes.
And those short sellers start losing money rapidly.
Exactly. To stop their losses, they are forced to buy the stock back at the higher price.
Which artificially accelerates the price upward even faster. It's a feedback loop of panic buying.
Right. So what we saw was a mix of fundamental sentiment shifting and mechanical forced buying. The sentiment shift is the most enduring part, though.
How so?
Well, D-Wave is no longer trading like a traditional tech company that gets punished for quarterly misses. The market is now trading it as a high-beta frontier asset with a state-sponsored safety net.
Now let's talk about the risks, because we can't ignore the bear case here. Let me push back on the actual mechanics of this $100 million deal.
Okay, sure.
According to the filings, the government is taking $100 million in common stock. As an everyday retail investor, doesn't that directly dilute the shares I might own?
It does, yes.
So why is the stock market cheering for an event that fundamentally dilutes the ownership stake of existing shareholders?
It's a fantastic question, and you are mathematically correct. Issuing new common stock is technically dilutive.
Right.
But in the world of frontier technology, you have to weigh dilution against survival. This $100 million acts as a critical capital bridge that essentially eliminates existential risk.
Meaning they were at real risk of just running out of money.
Exactly. Without this government injection, D-Wave would have likely been forced to resort to desperate, highly dilutive private secondary stock offerings.
Like a toxic spiral.
Yeah. When a company is bleeding cash and desperate,
Institutional lenders offer terrible valuations, creating a death spiral for the stock price, just to keep the lights on. The government deal prevents that spiral. It buys them the runway they desperately need on much more favorable, validating terms.
It's like a blockbuster movie studio that hasn't released a hit in months. They are bleeding cash, and suddenly they get the budget fully secured to film the next 3 sequels back to back.
That's a great way to put it.
The pressure is off the immediate payroll, but they still have to prove they can actually make a good movie.
Right. The cash burn is still a legitimate concern long term.
So with everything on the table, what's the final verdict?
Looking at the complete picture, the consensus points to a bullish score of 7 out of 10.
7 out of 10, okay.
Yeah. D-Wave offers a unique, pure-play entry into an accelerating sector. Yes, the fundamentals are early stage, and that cash burn is real. But the landmark $100 million U.S. government investment fundamentally changes the equation.
It de-risks their immediate survival.
Exactly. It accelerates their dual-platform timeline and provides a powerful geopolitical moat that none of their competitors currently enjoy. It represents a very rare window into how frontier technologies transition from experimental science projects into commercial government-backed infrastructure.
It's a messy transition, but one with enormous potential upside if they execute over the next few years. It's a multi-year play, for sure.
Absolutely. A solid multi-year investment view.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is grow $100 to 10K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.